Thank you. I'm really honored to have been asked to give the Kazimierz Łaski Lecture. You're a representative, I think, of left-wing economic thinking in Austria. There's a well-known remark by John Kenneth Galbraith, who was asked, this might have been sometime in the 70s, he said, why is Austria so successful economically? And he said, well, the answer is simple. All the economists of the Austrian school left Austria. And so maybe that's right. So the question I'm going to discuss is what would Keynes propose for the euro? The question of what Keynes would propose for today is a well-known parlor game. We all have our own Keynes, and Keynes lived in a different world from our own. But we can correct vulgar errors of interpretation. For example, Keynes didn't believe in continuous budget deficits. He paid proper attention to the financing of deficits and to issues of confidence arising from escalating deficits and debts. And he didn't repudiate monetary policy. He also attended to the external conditions for successful macroeconomic policy. So he wasn't quite the devil portrayed by the right-wing economists. However, we can start by asking what he considered should be the aim of macroeconomic policy. There's no doubt about his answer: full employment. He targeted employment because he thought that secure employment was the basic welfare good, ahead of, but consistent with, stable prices and equitable distribution. And he didn't believe that an unmanaged market economy could secure full employment, except, he said, in moments of excitement. This was because the future was radically uncertain and investment, therefore, would normally fall short of potential because you don't know what the returns are. There are other things you can do than invest your money in projects whose gestation period is far ahead. There was another reason why Keynes espoused the full employment policy. He thought it would bring nearer the day of abundance, which would enable most people for the first time in human history to live what he called wisely and agreeably and well. In other words, the full employment policy, by means of investment, was a stage in the gradual liberation of humanity from a life of toil. As the returns to investment fell, we would be able to devote more of our incomes to consumption. And as the returns to consumption fell, more to leisure, more time to leisure. This was the three-stage sequence that he envisaged in his essay, Economic Possibilities for Our Grandchildren, written in 1930 in the depth of the slump. So Keynes wasn't just a short-termist. Now, of course, he may have been over-optimistic in thinking that the returns to consumption would fall, especially with mass advertising only in its infancy. But still, that was the sequence he imagined. Today, we would want to add to this line of thought the risk of what he called technological unemployment, by which he meant, and I'm quoting here, unemployment due to our discovery of means of economizing the use of labor, outrunning the pace at which we can find uses for labor. The sense is clear. It's not the most elegant of sentences, but basically the demand for labor doesn't keep pace with the economizing of the use of labor. What we now call, I think, the challenge of the robots, or the coming of the robots. But he thought that the outrunning would be only a temporary phase of maladjustment to an abundant future. It was his commitment to the goal of abundance which made him so critical of the artificial recreation of scarcity through wars and depressions. May I also add that there is nothing in Keynes which suggests that full employment meant 2% or even 3% unemployment rate. In other words, he would have accepted Friedman's natural rate, the rate consistent with stable prices, as one possible definition of full employment. He would have sought to lower a socially unacceptable Nehru by incomes policies or labour market reforms, and would have looked favourably on Austria's corporatist wage-setting system. But this is a secondary matter for my purpose this evening, though I'll be happy to answer questions on that. So what I want to bring out is that there's still a lot in Keynes worth chewing. Today I want to concentrate on one meal, one little section of the meal he offers. That is a short-term one, and particularly on what he would have said about the failure in advanced countries today to provide for continuous full employment. Within this topic, what would he have said about the single European single currency, which has deviated most strongly from the Keynesian full employment objective? There's no doubt, in my mind, that Keynes would have been strongly opposed to the eurozone in its present form. He would have seen it as a modern gold standard and one which didn't even offer the possibilities of an escape. The following of its features would have struck Keynes as inimical to the pursuit of full employment policy. The absence, one, of a decent-sized eurozone budget for both counter-cyclical and transfer purposes, the absence of a central bank able to act as lender of last resort, and the absence of a European facility, let's call it a euro bond, to lend to governments. He would also have deplored the lack of flexibility in the eurozone rules. In the past, countries on the gold standard could leave it, suspend convertibility at the stroke of a pen. Extricating a country like Greece or Italy from the eurozone today would be much more politically and financially difficult and costly. With escape routes like suspension unavailable, and with restrictions on the movement of capital, goods, and labour ruled out, Keynes would not have been surprised that most Eurozone countries found themselves virtually defenseless when the economic crisis of 2008 struck. The crisis was overcome, though only partially and at tremendous cost, by the adoption of ad hoc measures outside the framework of the treaty. Mario Draghi's "we will do what it takes" in 2012 is the main example of this ad hoc response. But a monetary system cannot survive on the basis of ad hocery, which soon comes to be viewed as downright quackery, destroying confidence in the system's rules and hence the ability of the rules and the institutions to shape expectations. Keynes would have said that the way the eurozone was set up reflected a basic flaw in neoliberal macroeconomics. The flaw being the belief that provided inflation was controlled by central banks, a competitive market economy would be cyclically stable at its natural rate of unemployment. This meant both that the possibility of a slump was ruled out and no effective tools were in place to offset its effects. A slump of this kind would not happen. That was the Chicago School theory, which was the main theory in the pre-slump textbook Education of young economists. Now, these flaws were a joint product of Friedmanite economics and neoliberal ideology. Friedman believed that inflation and deflation are always purely monetary phenomena. He said so explicitly, and that absent inflation or deflation, competitive market economies would be counter-cyclically stable except for unexpected shocks. Well, of course, unexpected shocks were precisely the thing that were meant to be unexpected and very, very rare. And even when you did have shocks, they were expected to be random, they would be random, stochastic, and therefore wouldn't actually develop in one direction cumulatively or another. Germany added to this mixture, or to this Friedmanite doctrine, ordoliberalism. Market stability required not just monetary discipline, but a rule-based system to keep markets competitive. Both of these positions were blind to the interaction of prices and real activity, except in the very short term. I mean, the rational expectations revolution actually abolished the short-term Phillips curve, but most sensible people at least stuck to some version of it. The main lesson that Bernard Bernanke, Mervyn King, Mario Draghi, and other central bankers drew from the Great Depression was that the Federal Reserve Board had failed to prevent a collapse of the money supply. They were determined this shouldn't happen again. So in 2008, 2009, they started pumping money into their economies, money on a huge scale. The United States and Britain leading the way. The rapid recovery of 2009, 2010 has been interpreted as a poster picture of monetarist success. But, of course, what it ignored was the major contribution to recovery of expansionary fiscal policy in the United States and China. The expansion of fiscal deficits and national debts was viewed by orthodox opinion not as a necessary part of a recovery program, but as an obstacle to the self-generating recovery of private sector investment. Hence the near universal adoption of austerity, especially in the eurozone. I'm going to take this off because I'm getting a bit hot. Thank you very much. Now we come to austerity. Austerity wasn't just the product of a flawed economic model. It reflected the widespread political reaction against statism or over-big government, the essential background of which was the collapse of the planned economies in the late 1980s, but even before that, the crisis of Keynesian economics of the late 1970s. So shrinking the state was the unacknowledged ideological foundation of balancing the budget. That's what it really meant. Balancing the budget meant shrinking the state. Of course, you could have balanced the budget by increasing taxes, but that wasn't what they meant by balancing the budget. They meant reducing spending. And reducing spending without increasing taxes simply means that you're shrinking the state. And there's no logical connection, by the way, in macroeconomic policy between balancing the budget and shrinking the state, as I've just pointed out. But of course, the connection rather was in the association of the minds of the orthodox people between curbing welfare benefits and labor market reforms designed to force people back to work. And so that was what shrinking the state really meant. But in macroeconomics, this is just not the way to deal with a big collapse of demand. And here I want to insist on one essential point. European governments may have been more or less extravagant in the run-up to the recent slump, but the crisis of eurozone government finance was a direct result of the slump itself, of bailing out insolvent banks, of the collapse of state revenues, and the escalation of welfare payments. Banking liquidity crises have spread over into banking solvency crises, and solvency crises into sovereign debt crises. That was the sequence. It wasn't that the states were very, very profligate before the crisis, and that brought on the banking crisis because they lacked confidence or something. States weren't. Some states were more profligate than others, but they weren't extremely extravagant. Maybe Greece is some sort of partial exception, I don't know. But they weren't very, very bad. What brought the crisis of the finance was the collapse of the banking system. And it's the private sector that produced the slump, not the public sector. And that is the great myth that's been told and has, accepted by nearly all financial analysts and economic analysts. It was the profligacy of government. This was the grand narrative. And the trouble is that you have this dynamic, and this dynamic, as Paul de Groe, one of the economists of this, says, can force countries into a bad equilibrium characterized by increasing interest rates that trigger excessive austerity measures, which in turn lead to a deflationary spiral that aggravate the fiscal crisis. Now, you would have thought that restoring pre-slump growth rates as quickly as possible was a necessary condition for overcoming the fiscal crisis of the state. Instead, the bond markets imposed austerity policies which deepened the fiscal crisis by prolonging the economic crisis. So the whole policy was wrong, and not just intellectual error, but it had very, very serious consequences. Now, Keynes would have been highly skeptical of quantitative easing, certainly as a standalone recovery policy. Monetary expansion, he would have said, should be a natural accompaniment of expansionary fiscal policy. In fact, you can't have expansionary fiscal policy without expanding the money supply, obviously, but it would be too weak to bring about recovery on its own. I cite the following important passage from the general theory. It should be up there because it's sort of a key thing. If anyone tells you about quantitative easing, just try and remember this sentence. If we are tempted to assert that money is the drink which stimulates the economy to activity, we must remind ourselves that there may be several slips between the cup and the lip. If we are tempted to assert that money is the drink which stimulates the economy to activity, we must remind ourselves that there may be several slips between the cup and the lip. The cup was being emptied into the economy, but a lot of it was dribbling out, yes? And Keynes identified two such slips, or leakages, from the circular flow of money. The first, hoarding, and the second, speculation. They're subsumed in the more general concept of the speculative demand for money, or liquidity preference, as he called it. The withholding of money from investment in currently produced output because of the uncertainty of the returns, and therefore you don't commit your money. You hold it, waiting for an opportunity to come in, which means that a lot of the money being produced by central banks was not simply not being invested. It was going into cash, the cash reserves of the banking system, cash reserves of firms, paying back debt, and things like that. And the prolonged failure of ultra-cheap money to raise the rate of inflation in the years following the collapse of 2008, and even to this day, illustrates the weakness of the central bank as a monetary tool. What the monetary tool does and is good at, they can cause a depression, but they can't produce a recovery. In other words, if you restrict the money supply sufficiently and allow interest rates to skyrocket, you can produce a great, nice depression anytime. They, central bankers, can do that, but they can't produce a recovery. You put the money in the cup, and then there's all this slip between the cup and the lip. And so, what do they say? Sorry, I mustn't attack central bankers. Some of them are my best friends. What do they say? What do they say when you mention this? They say, well, of course, there were headwinds. Unfortunately, certain things happened, and therefore the policy was less effective. The price of oil was unexpected, and things like that. So anyway, I'm just pointing out that the 10 years after the crash, most Western governments remain on life support systems, with mediocre real recoveries being threatened by renewed asset bubbles, leading to renewed financial crises. Now, I now turn to what Keynes would have done about the eurozone. I've got there by a winding route, but I hope a route which is very important to understand the background. He would have agreed that it's very difficult for the eurozone governments to use expansionary fiscal policy to fight the slump. This isn't just a matter of restrictive fiscal rules, but also of the difficulty of changing these rules. The truth is that the Eurozone's flawed economic model is embedded in the treaty structure of the EU and particularly of the currency area. That is, one cannot be a Keynesian in the Eurozone and to a lesser extent in the wider EU without changing the treaties. Keynesian policy is excluded by the constitution of the system, and deliberately so. This represents the disastrous triumph of Friedman economics and German ordoliberalism. Now, of course, ways have been found because, the countries concerned want the Eurozone to go on in some way, and ways have been found of bypassing the rules, central bank rules, bypassing the fiscal rules, bypassing all the rules, in order just to keep the show on the road. But not without a lot of brinkmanship and without key issues still unresolved. People criticize Trump for brinkmanship, and he does. He's a constant brinkman. But the European Union lives by brinkmanship. There's always a crisis, then they all get together and spend, hours and days, and then everyone speculates, and the markets go all mad, and then they finally come up with a solution. I mean, it lives by brinkmanship, and always in the hope that each new crisis will bring about some forward movement. But what happens is the train just jumps up and down on the railway lines, but there's no movement. I think this is a huge problem. The Eurozone started in 1997 on the false premise that all members would have currencies as hard as those of Germany, the Netherlands, and Denmark. And if that was so, if that premise was correct, no provision needed to be made for fiscal transfers, Eurobonds, and so on. You didn't have to allow for that. For a time, it's true, a rising tide, as they say, lifts all boats, and that was true in the 2000s. Everyone sort of benefited from, the tide was rising. But as soon as the tide started to recede, it was clear that some economies were still afloat and others were beached. This illustrates the general rule that in the ebb and flow of economic life, there will always be creditors and debtors, and incentives have to be in place to minimize the losses arising from both kinds of imbalances. This was the object of Keynes's clearing union plan of 1941. Its main purpose was to prevent current countries running persistent trade surpluses. These, as he saw it, imposed deflation on the deficit countries, who, if they were strong enough, would respond by putting on tariffs or depreciating their currencies. The International Monetary Fund, set up in 1944, rejected Keynes's logic of creditor adjustment, but as a sort of compromise, it included in Article 7 a scarce currency clause, which allowed members of the fund to restrict their purchases of goods from countries whose currency the fund had declared scarce, that is, from countries which ran persistent trade surpluses. Keynes understood that in order to have a good trade system, you had to have a good payment system. Article 7 could today be reasonably invoked by Mediterranean members of the IMF against Germany, had they not been in the eurozone. But in the eurozone, you cannot do it. You can't start restricting purchases of goods from surplus countries. Italy hasn't got the solution or the option of saying we're going to restrict German goods. Neither has Austria, neither has Greece. That's forbidden by the rules. You cannot have import restrictions. It's forbidden by treaty. So, we can think of the design of a reformed Eurozone along two dimensions. One, improved institutions, and the other, escape clauses. In the former would fall a common budget managed by a single political authority, a central bank able to act as lender of last resort to the commercial banks, and a European monetary fund able to lend to countries in temporary current account problems, difficulties. The purpose of the second would be to provide Eurozone members with borrowing facilities greater than available under as members of the IMF. Secondly, escape clauses, very, very important in any system. You would allow countries to remain in the system while suspending some of the rules for some of the time. In other words, rules enjoining free movement of goods, capital, and labor under specified conditions and for a specified period, and with the approval of other Eurozone members. This would allow for crisis measures to be incorporated in the constitution of the monetary union and not added to it as ad hoc measures. Acceptance of the escape clauses would signify recognition that German ordoliberalism is not enough. Keynes was always against the rule of lawyers. He said this was the terrible thing he found in the United States, that it was always ruled by law. He said, what I wanted lawyers to provide me with is rules flexible enough for me to do what is sensible. That's a classic Keynes remark and a Keynes attitude, not ordoliberalism. Being a constructive thinker, Keynes would surely have been putting forward a grand reform plan along these kind of lines. The EU is inching towards this, but too little, too late. For example, the Commission wants a European investment budget of 30 billion to be available for counter-cyclical purposes in a recession. This is a symbolic amount. Had we been talking of 350 billion, then, as the IMF implied, would be necessary for a proper investment program, we would be serious. In any case, the idea of a rainy day budget is all wrong. It's all wrong. We want a budgetary policy which stops the rain from falling at least in a continuous downpour, not one that acts only when the rain has started. In other words, the rainy day analogy I would reject. So what would be the principles of a European budget? Well, you've got to get rid of the idea of zero budget balance, enshrined in the EU fiscal constitution. This is economically illiterate, the idea of zero budget balance. Normal times should include provision for a state investment program. Without it, the times will not be normal. So we need to restore a principle accepted 20 or 30 years ago, that the budget for current spending should be balanced. That balance, by the way, to include a provision for debt repayment, but that the investment budget should always be unbalanced. Of course it's got to be unbalanced, allowing for a revolving fund of investments. What we don't want is for the investment budgets to steal money always, or for things to be counted as investments which shouldn't be. And there's a lot of cheating possible. But you can set up a proper public accounting system in which, any attempts by government to fiddle these figures would be exposed. That's not beyond the bounds of, human intelligence or institutional innovation. What I'm suggesting here is a revival, those who know their economic history, of the real bills doctrine. I won't say anything more about it now than that. That's to say, you set up a revolving fund as one investment project is completed. So, the fund revolves, but it doesn't expand. So you're not in the business by saying the state should be run a permanent investment program. You're not in the business of saying the national debt should be going up continuously. The national debt can be held constant at whatever level you want it. We read, as another reform, that Angela Merkel is inching her way towards agreeing to transform the ESM, the European Stability Mechanism, into a European monetary fund, with new credit lines for short-term lending and provisions for debt restructuring. In principle, this is a good idea, but there are big issues we don't know about. How big will the fund be? Who will run it? On what conditions will its loans be made? They obviously have to be at concessionary rates, but that implies supervised conditions. Who's going to do the supervision? The Troika was too lax. It's the Germans who are going to do the supervision. All these issues are still very, very much in the air. We don't know the answers to them. But what we suspect is that although the deficit countries will be given transitional help for what is called internal devaluation, no pressure will be brought on surplus countries for internal revaluation. That's where we are. In fact, if the managers of the new institution are to be majority shareholders, the programs will be in the hands of those who strongly deny the need for internal revaluation. And, by the way, whose decisions are likely to be challenged in German constitutional courts. Well, I'm coming to the end of what I want to say. You see, the difficulty we face is that it's not just a question of winning intellectual battles. I think we can win intellectual battles. The problem is the institutional battles. In the old days, if you wanted to be a Keynesian, if a government wanted to be a Keynesian, they just were. They didn't have to ask anyone. They just had, there were no constraints. Of course, there were some internal constraints. There were constraints on the United States. The president can have a budget. Congress, obviously, can oppose it. And you have a balanced constitution. But in the European countries, Britain, France, Germany, Austria, if they wanted to pursue Keynesian policies, there were no constitutional restrictions on it. Now, we're in a system where we're hedged with constitutional restrictions on fiscal policy, on monetary policy, and so it's hard to break out of that cage. You can win the intellectual battle, but the institutional battle is much harder. So Keynes would have said, okay, we fight for our reforms, but suppose we don't succeed. Is there a second best position? And he would have been thinking about a second best position. What would a second best look like? Suppose the eurozone couldn't be saved, couldn't be salvaged, that, you know, crisis after crisis hit it and it started breaking up. There, again, I'm not just speculating. I refer you to some articles Keynes wrote in 1933 called National Self-Sufficiency, and it was written in the aftermath of the collapse of the gold standard. These can be read not just as a critique of globalization, but also of the neoliberal economics underlying today's eurozone. Here, this is what Keynes said. Of any international system, we require that it deliver the goods. If it fails to do this, the world will, I'm quoting, embark on a variety of political economic experiments. Not believing that we are saved already, we each would like to have a try at working out our own salvation. We do not wish, therefore, to be at the mercy of world forces, trying to work out some uniform equilibrium according to the ideal principles of laissez-faire capitalism. We wish, for the time being, to be our own masters. Now that is an endorsement of nationalist economics as second best. And that has a lot to say to us today. Liberals need to be put on their mettle, not just assume they know best and everyone else is a fool. And liberals are quite bad at doing that. Keynes's philosophy, I think, he's a difficult thinker, so we mustn't just, buy the easy Keynes and forget the difficult Keynes. Remember, he lived in terribly turbulent times, and he was trying to navigate as well as anyone else. His philosophy was consistent. We should try for the first best, always. And the first best was represented by a managed system of global trade and payments. That was the first best. If we can't achieve the first best, we should try to make the second best work as well as possible. And of course, the dilemma is, at what point should we give up on the first best? At what point should we give up on the first best? That is the dilemma at the heart of the political economy of Europe today. Thank you very much.